What if I told you that the single most powerful wealth-building tool in history requires no special skills, no insider information, and is available to anyone with a brokerage account? Millions of people walk past it every day, but a quiet group of patient investors have used it to turn modest savings into life-changing fortunes. In 1965, a 35-year-old man from Omaha, Nebraska, took control of a failing textile company called Berkshire Hathaway. At the time, it was worth about $18 a share. Today, a single share costs over $600,000. Warren Buffett didn't build that wealth through complex derivatives or high-frequency trading. He used something far simpler. He let money make money, over and over again. This is compound interest. Einstein reportedly called it the eighth wonder of the world. Whether he actually said that or not, the math behind it is genuinely extraordinary. Here's how it works. If you invest $10,000 and earn 10% per year, after year one you have $11,000. But in year two, you don't just earn interest on your original $10,000, you earn interest on the $11,000. That extra $1,000 is now also working for you. By year 10, your $10,000 has grown to almost $26,000. By year 20, it's nearly $67,000. By year 30, you're looking at over $174,000 from a single $10,000 investment. The rule of 72 is a quick shortcut to understand this power. Divide 72 by your annual return, and you get approximately how many years it takes to double your money. At 7% returns, your money doubles every 10 years. At 10%, every 7.2 years. At 12%, the kind of return the best dividend growth investors have historically achieved, your money doubles roughly every 6 years. Now here's where it gets interesting. Compound interest is powerful on its own, but there's a turbocharged version of it that most retail investors completely ignore: dividends. A dividend is a cash payment that a company makes to its shareholders, typically every 3 months. Think of it like rent. If you own shares of a company, you are, in a very real sense, a part owner of that business. And profitable businesses share those profits with their owners. The average dividend yield in the S&P 500 has historically been around 2%. But dividend-focused investors don't settle for average. They seek out companies with higher yields, stronger growth trajectories, and what's called a dividend aristocrat status. Companies that have increased their dividends for 25 consecutive years or more. Companies like Coca-Cola, Johnson & Johnson, Procter & Gamble. These household names have paid and grown their dividends through recessions, market crashes, and global pandemics. Coca-Cola has raised its dividend every single year for over 60 years. But here's the key insight that most people miss. The real power of dividends doesn't come from spending those payments. It comes from reinvesting them. Every dollar of dividend you reinvest buys you more shares. Those shares then generate their own dividends, which buy more shares, which generate more dividends. The snowball has started rolling. Let me show you exactly how dramatic this becomes with real numbers. This is the DRIP effect, dividend reinvestment program. Imagine you buy 1,000 shares of a company trading at $50 per share, a $50,000 investment. The stock pays an annual dividend of $3 per share, a 6% yield. In year one, you collect $3,000 in dividends. You reinvest every cent, buying 60 more shares at $50 each. Now you own 1,060 shares. In year two, those 1,060 shares generate $3,180 in dividends. You buy another 63 shares. You now own 1,123 shares. But what happens when the company also raises its dividend by even a modest 5% per year? Now your growing share count is compounding with a growing dividend per share. By year 10, you own over 1,700 shares and your annual dividend income has climbed above $8,000. Your original $50,000 investment is now generating 16% income on its original cost basis every single year. By year 20, your annual dividend income exceeds your original investment. You are living off the interest of the interest of the interest. This is what investors call a cost yield, and it's one of the most satisfying concepts in all of finance. Here's the key. You haven't even touched the potential capital appreciation of the stock itself. The dividend snowball is only half the picture. So how do you actually build a dividend portfolio that works? Let me give you a practical framework. First, look for quality over yield. A 12% yield might look attractive, but if it's not sustainable, the company will cut the dividend, and the stock price will crater. The sweet spot for dividend growth investing is typically a yield between 2 and 6%, paired with a payout ratio below 60%. The payout ratio tells you what percentage of earnings the company pays out as dividends. Lower is safer. It leaves room for the company to grow the dividend and weather difficult periods. Second, look at the dividend growth rate. A company paying 2% today that grows its dividend 10% per year will be paying you far more on your original investment than a company paying 5% with no growth. Time amplifies growth rates dramatically. Third, diversify across sectors. Don't put all your dividend eggs in one basket. Utilities, consumer staples, healthcare, financials, and real estate investment trusts, or REITs, all have strong dividend cultures. Spreading across sectors protects you if one industry faces headwinds. Fourth, use tax-advantaged accounts. When possible, hold dividend stocks inside an IRA or 401k. This lets dividends compound without the annual tax drag, supercharging your long-term returns. And fifth, be patient. The dividend machine doesn't create wealth overnight. It creates wealth over decades. Every quarter that ticks by with dividends reinvested is another rotation of the flywheel. Here is the truth about building wealth that the financial media rarely tells you. It's boring. It's supposed to be boring. The most powerful wealth-building strategy ever devised is to buy great companies, collect their dividends, reinvest every cent, and wait. The people who win aren't the ones glued to ticker symbols. They're the ones who set up their drip accounts and then go live their lives. Warren Buffett put it this way: the stock market is a device for transferring money from the impatient to the patient. Dividends are the reward for patience. If you found this valuable, hit subscribe. Every week, Market Mapped goes deep on the investing strategies, stories, and data that help you build real wealth. Not hype, not noise, just the signal. So how do you actually build a dividend portfolio today? You have two main options. Option 1, individual stocks. Pick 15 to 20 companies from the Dividend Aristocrats list across different sectors: consumer staples, healthcare, utilities, financials, industrials. This gives you real diversification. Aim for companies with at least 10 years of consecutive dividend growth, payout ratios below 70%, and yields between 2 and 5%. Option 2, dividend ETFs. SCHD, the Schwab U.S. Dividend Equity ETF, has become a favorite among investors for its focus on quality and dividend growth over raw yield. VYM from Vanguard and DVY from iShares are also strong choices. ETFs give you instant diversification across dozens or hundreds of companies.